If you watch the violent swings on a crypto market chart, it is easy to assume the industry is an unstable casino. The mainstream conversation rarely looks past retail day trading, Bitcoin price spikes, and the latest Federal Reserve interest rate hikes. But underneath that surface-level noise, a quiet evolution is taking place. Traditional financial assets are steadily migrating onto the blockchain. The industry calls this tokenization. It is the process of taking traditional assets, like stocks, bonds, and real estate, and converting them into a digital token format. It changes the mechanics of how we interact with value in the same way the internet changed how we interact with data. Major platforms have a definitive endgame in mind. They are building the everything exchange, the infrastructure for the global financial system. Building an architecture that holds multi-trillion-dollar traditional assets requires one specific requirement: permanent, clear regulatory rules from the U.S. government. The market is moving faster than the law. In the last 30 days, stablecoin transaction volume alone reached multiple trillions. Without regulatory certainty, the companies building this technology have signaled they will abandon the United States to do business offshore. Congress recently introduced a legislative solution designed to keep this industry onshore, the Clarity Act. Lawmakers are now racing to pass this legislation before the August recess to provide the market stability needed for these businesses to remain in the United States. Getting the Clarity Act ready for a vote took 10 months of rigorous drafting. Lawmakers worked to create a comprehensive, market-ready framework. The bill offers specific consumer protections. It outlines rules against market manipulation, stop the front-running of trades, and ensure integrity for digital exchanges. These are the safeguards that the banking establishment and federal regulators have been demanding for years. Since the legislation achieves the specific goals crypto skeptics have always wanted, its sudden halt at the finish line contradicts typical legislative logic. The roadblock stopping the bill stems from a sudden partisan fight over presidential ethics provisions. A group of Senate Democrats is demanding amendments that would force the president to place any private crypto investments into a blind trust. The counter-threat was immediate. If the ethics language is perceived as specifically targeting Donald Trump's pre-existing digital assets, he is expected to veto the entire bill. Senator Cynthia Lummis has pushed back against the amendments, arguing that private citizens must retain their rights to make money on investments before taking the oath of office. Meanwhile, lawmakers like Representative French Hill argue the dispute misses the point. He notes the Clarity Act already creates a transparent market framework that would provide oversight for any family investments. The result is a stalemate where a technological upgrade to the U.S. economy is being delayed by a localized, partisan ethics dispute. Washington faces two potential outcomes. In the first, a compromise is reached, the bill passes, and these policies become permanent U.S. law. This creates a safe harbor, keeping the everything exchange and tokenization on American soil. In the second outcome, the standoff continues until the August recess. The clock runs out, the bill dies, and the regulatory vacuum remains. The technological shift toward tokenization is occurring globally. It will not wait for Washington, D.C. to resolve its internal political feuds. The crypto industry will simply build its future elsewhere. The final casualty of this ethics battle will likely be America's position as the primary hub for global financial innovation.